Welcome back to another episode of the Rentvesting Podcast. On today's show, I have Jason Wong, who works in investment banking, predominantly managing high net worth individuals. Now, Jason also runs a very popular finance and education blog, which is how we originally got into contact. That blog is jasonjots.com, and the aim of the site is really to simplify finance. And that's exactly what we discuss as Jason demystifies the equities market for us. So, let's get to it. Jason, hi. Thank you for joining us on the Rentvesting Podcast. It's great to have you on the show.
Hi, Peter. Glad to be on your show.
Fantastic. Jason, why don't you start off by telling our audience just a little bit about yourself and what it is that you actually do?
Sure. Hi, everybody. My name is Jason, as Peter has mentioned. I'm a career finance professional. I graduated uni probably about 10, 11 years ago and have been in finance ever since then. Current job being a fund manager, and what my job entails is basically just to provide financial or investment advice to high net worth individuals who would like a bit of a helping hand to put some money into the stock market. And that's basically what I do.
Not an easy job, Jason, particularly considering the recent market volatility. I would assume there would be a couple of phone calls that you would have to field each day from your clients calling in to be wanting to know what's actually taking place out there.
Yeah, that's right. I mean, the hardest job in the world is to field calls where you have to explain why you might have potentially lost somebody their retirement fund. I mean, we do our best. We can never get it 100% correct, but it's...
Yeah, I always take the opinion that investment is an emotionally charged sport, really. It's a contact sport, and, those emotions can really significantly influence the outcomes that people actually achieve. Do you think the investors that you deal with, or just as a general statement, do you think that they actually appreciate that their own influence can have a net impact on the overall results that they achieve in the equities market?
Yeah, I mean, there's a famous saying that we always like to use in our industry, and that is risk is a function of someone's expectations. Mm-hmm. So, how we invest our client's money is really dependent on how the client perceive value. And yes, if they want a particular outcome, and if it's not met with the investment choices that we put his money or his or her money into, then obviously he's going to let us know about his unhappiness, and that's going to definitely affect how we invest this money. So definitely clients' own perspective on how investment should be made certainly plays a big factor in swaying how we invest their money.
Mm-hmm. Mm-hmm. And what do you contribute to, or what are some of the factors that are contributing to the recent market volatility that we're experiencing?
I think a lot of factors that the world hasn't been able to forecast. I guess it all started with the UK public saying that they wanted to leave the euro. Mm-hmm. And I think that's really what started the snowball effect that has led to where we are at right now in terms of market volatility.
And has the Trump factor kind of knocked it out of the park a little bit further, or?
Yeah, I think the Trump factor is a double whammy sort of thing, where the markets weren't expecting Brexit, and come to Trump, where Hillary was by far leading in the polls right up to the election day. Everybody was expecting that Trump had no chance to get the nation, and the fact that he did basically threw everybody off balance, and that everybody was gearing their investments for next year in a Hillary president world.
Uh-huh.
Now, Trump being in the picture, obviously everybody had to reassess their investment plans, and therefore those two factors, I guess, in aggregate, is contributing to what we see as market volatility at this point in time.
Yeah, I guess by default, there's a perception that Trump's behavior is unpredictable, which markets hate. If there's anything that I know, which isn't a huge amount with what happens on the stock market, anything that is non-vanilla in flavor is potentially detrimental.
Exactly. And the reason why people don't like that uncertain factor is because people can't look into the future. I mean, if you look at what makes up the valuation of the stock market, it's people looking 12 to 24 months into the future and putting a financial model around their expectations to come to a value that they perceive to be what the company is worth at this point in time. So if they can't predict that, then nobody really knows what to do, because that just throws fundamental analysis of stocks into chaos.
So what are the fundamental aspects behind the analysis process that investors should actually be looking at, removing the unpredictable nature and the emotional qualms that they may face?
I guess just going back to facts. I mean, if you take again America being a prime example, Trump in his campaign trail, he was telling the market that he was going to make America great again. He was going to bring all the jobs back into the country. He's going to build bridges. He's going to accelerate infrastructure spend. He's going to build walls between the U.S. and Mexico. I mean, while it's all in good, the president-elect telling everybody he's going to spend big to really boost the U.S. economy, the fact is that the U.S. is running a big debt balance on its capital accounts at this point in time. I mean, I read somewhere just last week that the U.S. currently holds about $67 trillion in debt at this point in time, and with national savings at somewhere around 2.5%, which means people haven't really saved for a rainy day. I mean, you got to question
it's astronomical, those figures, isn't it? It's just to even try and get your head around how big $67 trillion actually is.
Exactly. And at the end of the day, he needs the money to actually do half of the things that he says he's going to do. Mm. And without the money, basically you can't do anything. So it's all about going back to the fundamentals, look at the facts, and make a judgment call as to whether he can come through with his promises, basically.
I myself, I've dabbled in equities over the years. I've had some wins, I've had some losses, and I don't hold any more than small allocations here and there in a few blue chip stocks. So I'd certainly say that I'm not a sophisticated investor in that regards. But I guess what kind of gets me offside or having a willingness to go all in would be on, I guess, some of the technical terms and the lingo that's actually used within the industry. Can you help demystify some of those common terms that are thrown around?
Yep. So I don't know what it is about industry, but we like to throw out complicated words out there. Maybe it's just how it's always been that way, and it just makes us sound smarter, I suppose.
Yeah, not like any industry. Yeah,
exactly. But I mean, some of the common lingo you will hear when you speak to finance professionals in the market are terms around EPS, which means earnings per share, and that's really all equity fund managers concentrate on, and that's basically what earnings is being generated per dollar of share. And it really all comes down to giving an indication of what the company is earning and translating to returns for shareholders. Another common term that you see being thrown around in the industry is PE ratio. And that basically means price to earning ratio, and it's a quick fire way to value the worth of a company. So obviously, the higher the PE, the more you have to pay for the company. So people might pay up for the company if the company is showing very good growth rates for the future, if they're going through a growing industry, for example. And just to give you a better understanding of how this applies in the real world, when looking at the papers yesterday, we saw Bellamy's take a big hit over the past week. And if you're unsure about Bellamy's, it's all about infant formula.
Oh, yes.
And how...
White gold, isn't it?
White gold, that's it. It's all about, the company basically benefiting from the huge demand coming from China.
Uh-huh.
And it was under that thematic that investors were willing to pay up to 22 times PE for the stock, based on the very fact that the company was going to grow very, very strongly because of the demand coming from China.
Mm-hmm.
Now, obviously, last week, the growth potential was basically slashed in half because the company came out with a updated guidance on sales numbers.
Right.
And therefore, that meant that investors, whereas previously they were willing to pay 20 times the company's earnings, now are only willing to pay 12 times the company earnings.
Right. So what impact did that have on the stock? How far has it dipped over the last few days?
Well, it's basically halved.
Mm-hmm.
So before the news, it was trading at $12 to $50, thereabouts. And now I think today it closed at about $7.
Right.
So yeah, talking about volatile markets, that's one of the more extreme examples that I can give you.
I had heard one, and this is going back a little while and related to the Ebola virus. And you could correct me if I'm wrong on this, but I don't know the specific name of the company, but they were manufacturers of hazmat suits.
Yep.
And traders went all in on this hazmat suit company on the expectation that there was going to be a global outbreak of Ebola, which would send the demand for hazmat suits through the roof, which I thought was incredible at the time in terms of people's thinking and opportunistic behavior to actually potentially cash in on a crisis. But I guess that's just the way the market behaves.
Exactly. Everybody takes a piece of news and they put it into their numbers and extrapolate it over the next 2-3 years. And obviously, that assumes that things don't change. And in this case, things did change because Ebola has, I suppose, been eradicated. And what was expected to be a good business obviously turned out to be a bad business.
Yeah. From a technical jargon perspective, what are some of the other factors or some of the other commonly used terms that could perhaps be broken down as well, Jason?
Yeah, so I suppose other terms that we use quite regularly is EBITDA for the company. So EBITDA basically means it's earnings before interest, tax, and amortization. And it's just another level of metric that investment professionals use to look at a company's profitability. We've got other terms like free cash flow, and that just means how much the company is turning its activities into cash after consideration all the cash needs of actually running the business. What else have we got? Have you heard of any terms that puzzles you that you want clarification on?
None other than what you've already discussed. The PE ratio always gets me confused, but I guess then you get into the more complex investments that are available and looking at swaps or derivatives or buying short or selling long, and then there's currency exchange and all the rest of it that goes around it, but that's probably for another conversation.
I suppose that I mean, that's just going on to just elaborating more on the technical jargon. I mean, it's not an easy market to be involved in if you're not in the industry. It's just because there are so many terms that does not make sense to the normal person, and you need it's times like this that you need an investment professional to help you achieve your long-term financial goals. Because to take it on yourself, you're probably introducing more risk into your investment portfolio than otherwise necessary.
So seek the professional advice. Maintain an alignment to your overall investment goals. Be prepared to, or be patient to appreciate the timelines that could be involved. Is there any other factors that should be commonly referred to, do you think, Jason? Or
yeah, I mean, at the end of the day, it's a partnership. It's about you as a client working with your financial professional to achieve your long-term financial goals. I mean, it's not a competition between the client and the finance professional. I mean, everybody is on the same team. It is to money over the long term. And, just got to remember that no one can get it 100% right. There are mistakes to be made, as always. I mean, unless someone's got the crystal ball, which
please let me know who they are.
I'd like to have one if they know where I could get one. Yeah. But as a financial professional, if you get it right 60% of the time,
you're doing really well.
Exactly. So.
Now, before we finish up, there's one thing that you actually haven't mentioned, Jason, and that's the blog that you actually run, which is how we first connected.
Yes.
So how can people find out a little bit more about the content that you share and what you produce? Because what I've read, you're constantly demystifying, common trends that are happening in the marketplace or your own ideas of investments. So where can people go to find out more about that?
Yep. So the website is basically www.jasonjots, that's JOTS.com, jots.com. And the website is basically, as you mentioned, all about demystifying all the technical jargon that is being thrown around on the market. The idea behind this website is because has come from a place where, being in investments and being in the financial market, I regularly get asked questions from friends and family about what this means, what that means. And it has led to observation that, the market is indeed overcomplicated itself. It has way too many terms out there that not everybody can understand. And if you really want to do better in generating wealth over the long term, you have to understand what you're looking at. And the website is all about basically putting all the concepts in basic language and giving everybody a fair chance in generating long-term wealth.
Well, I think you're doing an excellent job with jasonjots.com.au, so well done. And Jason, thank you very much for giving up your time and making a contribution to the Rentvesting podcast. It's been great to have you on the show.
Thank you for having me, Peter. It's been a great time.
Good on you, Jason. Bye-bye.
Bye.
Thanks for joining us on another episode. Now, to keep the podcast going, I would really appreciate some help. And that would be to subscribe and also share your individual iTunes ratings just to keep this show in the charts. That way, we'll be able to increase our listener base, and that'll allow us to put more and more resources into pumping out quality content for everyone to listen to on a weekly basis. So thanks for helping me out. And look, I hope everyone is already having a cracking 2017. And let's chat again next week. Bye-bye.